All right, so today on Talk Tickers, we're digging into a real head-scratcher from Masimo's latest earnings call. The company reported what looks like fantastic numbers. I mean, a clean beat and raise, but the stock immediately dropped. So what did Wall Street see that the headlines missed? Let's get into it. Okay, so this slide right here, it perfectly illustrates the paradox we're talking about. On the left, you have all the signs of just a stellar quarter, right? Earnings beat estimates by a solid 10%, and margins expanded by a massive 450 basis points. But then you look to the right, and you see the market's brutal verdict. The stock plunged nearly 5% on a huge spike in trading volume. This disconnect is exactly what we need to understand. What spooked investors so badly? To figure that out, we've got to first appreciate just how solid the reported numbers really were. I mean, on the surface, this was a very, very strong quarter for Masimo's core business. First up, let's talk bottom line. Masimo delivered non-GAAP earnings of $1.32 per share. Now, that's not just a beat. It's a 12-cent beat over what analysts were expecting. That points directly to some excellent execution and really tight control over expenses. And, it wasn't just about cutting costs either. The top line was also pretty impressive. Their core healthcare business grew at a very healthy 8.2% year over year. So what does that tell us? It tells us that hospitals and clinics are still eagerly buying their essential monitoring technology. Demand is there. Now, this is arguably the most impressive one of the whole quarter, a 450 basis point expansion in operating margins. For those of you who don't live and breathe this stuff, that's a massive 4.5% increase. It's just a crystal clear sign that the company's efforts to become more efficient are having a huge impact on their profitability. Okay, let's switch gears and talk about the narrative management was pushing on the call. It was all about a strategic pivot. They're doubling down on what made them successful in the first place, their core healthcare technology. And look, management backed up this back-to-core story with some really decisive action. They sold off their consumer audio business, Sound United, and immediately put that cash to work paying down debt and buying back a hefty $350 million worth of their own stock. On top of that, they doubled down on their partnership with Philips. The message to investors was loud and clear. We are a healthcare company, first and foremost. Management was especially excited about the expanded Philips deal. As the CEO, Katie Simon, put it, they are still significantly underpenetrated in Philips' vast network of patient monitors. In other words, even with a long-standing partner, there is still a massive untapped market for their tech, which suggests a really clear path for future growth. So if the results were strong and the strategy seemed sound, what exactly spooked the market? Well, the answer, as it so often is, lies not in the past, but in the future, and specifically in the company's forward-looking guidance. This gets to the absolute heart of the problem. On the left, you see the sunny forecast management initially provided, but then, on the right, you see what happens when you add in the storm cloud of new tariffs. Suddenly, the expected earnings per share drops by a significant 22 cents. This is the uncertainty that spooked the market. It's not about the quarter they just had. It's all about the potential hit to profits in the quarters to come. And this tariff news couldn't have come at a worse time. As you can see from this chart, Masimo was already a major laggard. The stock is down 11% over the past year, a period where its peers in the medtech space were actually up, and the broader S&P 500 was up almost 14%. So this new guidance just poured a whole lot of salt in the wound for some already frustrated investors. So let's put all the pieces together. The strong execution, the strategic refocus, and this new tariff overhang. Here's our take on Masimo as we head into the end of the year. So where do we go from here? Well, we're initiating coverage with a market perform reading on Masimo. And what that basically means is we expect the stock to perform right in line with the rest of the medical device sector. While the core business is absolutely firing on all cylinders, this tariff issue is a real and unpredictable overhang. The market seems to have it priced about right, for now. The next big event to watch, it's going to be the company's Investor Day on December 3rd. Now, for traders looking for a specific catalyst, that upcoming Investor Day is key. The core idea here is that the market might be a little too pessimistic about these tariffs. If management can come out on December 3rd and announce a clear plan to deal with them, maybe by shifting their supply chain or something similar, the stock could see a significant pop. A potential way to play this is through call options, which would let you bet on that upside with a defined amount of risk. We'll be watching for any news on tariff mitigation and their long-term profit margin targets. This is not financial advice.